Okay, today I'm just going to read through Bill Belt's rolling put diagonal trading plan. This is version 5 from August of 2024. Uh, so a brief explanation. Some traders identify the term diagonal options with the poor man's covered call put, where you buy a long-term in the money option and sell an out of the money near-term option to finance it. This is not that long diagonal strategy, and frankly, is just the opposite to take advantage of buying power. The rolling put diagonal is an income strategy, and frankly, it's just a strategy, and it's based on momentum and selling a near term at the money option while protecting it with a longer term out of the money lower delta option. It is a hybrid combination of a put credit spread and a calendar spread, making it a diagonal. It starts off as a debit trade, and through multiple rolling of the short leg without reinvesting in the long leg turns into a net credit income trade. It is a flexible trade offering multiple adjustment choices and takes advantage of data and time decay. It has roots in the trading plan from Trader's Edge called the money press, except it is using index options and takes advantage of daily expirations. This is a mildly bullish strategy. In a bearish market, it is best to either sit it out or more aggressive trader may buy back the short put and let the long put grow from market pullback. The success to the rolling put diagonal is being in the right momentum with a longer term market and daily management of the position. There really is no risk graph that can be shown because it starts off as a two-legged debit trade and with daily rolling of the short accumulates into a net credit. What this trade is not is a day trade where you need to be glued to your computer watching the screen, or a trade where one or two candles require an immediate adjustment. The rolling put diagonal allows you to grow your account by the passing of time if you can identify when the market conditions are right for the trade and knowing when it is not right. A high level overview of the rolling put diagonal is using an example of an air balloon, air in a pair of balloons. One balloon represents your long protective position, and the other the short income position. The air escaping in the short position balloon is to your advantage because it is capturing value from the passage of time, while air escaping in a long position balloon can be thought of as a disadvantage in value, but an advantage in insurance protection and margin management. Basically, you are looking for the air in the short position balloon to escape at a faster rate than the air in the long position balloon and do it many times over. Delta management and capturing the extrinsic value is critical to the success of the RPD. For those that are comfortable with option Greeks, this is a strategy managing both delta and thetas. On the delta, you want to make sure that the delta on the short is higher than the delta on the long. Otherwise, you will lose more money on the long protective leg in a bullish movement than what you are getting from the short income leg. Also, when you roll, you will want to watch the theta decay on when to roll and possibly which strike to roll to. You want to roll the position when the theta on the current short position is lower than the target short strike, so you will continue to have maximum time decay. Charts. Charts are a trading tool that will work until they do not work, so I believe it is important to follow the KISS principle. I have seen charts and very exotic indicators in multiple screens up representing various time frames. My chart is set up simply using a price line for the price action, SMA 9 or EMA 9 in a stepped line and a MACD. Use whatever time frame and indicators you are most comfortable with to tell you the overall momentum. However, do not have too many indicators that cause confusion and do not have too short of a time frame. Since this is more of a swing trade, shorter time frames add too many false signals. So I usually use a longer term chart, such as a custom 78-minute, custom 98-minute, 130-minute, or daily chart, but may look at a weekly chart for confirmation. I do not want to see weekly lows getting lower. The chart I use tells me with what I believe is clarity when the momentum is bullish and when it is not. Here's my chart using TradingView, but you can use whatever platform indicators you're used to. This is not a chart intensive short time frame strategy, nor is it one that you should be glued to your screen. As a matter of fact, I have personally done more damage to myself watching it as a day trade by treating it as a collecting of premium through time decay on a slightly overall bullish movement. What I am watching on the longer time frame chart is number one, if the MA9 is stepping up. Number two, if the price line is above the MA9. Number three, if the MACD histogram and lines are staying bearish or bullish or changing momentum. Since the RPD is a bullish to flat strategy, I want to make sure there are at least two daily green candles that are closed and above the MA9 line, and the MACD lines are bullish. The exit rules are equally as simple. If the price drops under the MA9, I either close the spread or buy back the short put and let the long put appreciate as the price drops. In all transparency, I have found it's better to just close the spread and wait for two green bullish candles above the MA9 line again than to try and grab a directional appreciation from the long put. Sometimes it works and sometimes it doesn't work. I hate when I see a couple of weeks of income go away because I was trying to grow the long leg only. Be careful if there is a gap down beneath the MA9 line. More times than not, I have seen a continuation of weakness in that case. The right underlying. The stock or ETF needs to meet the following requirements. The stock must have significant volume or at least 2 million per day. Weekly options a minimum. It cannot be volatile with price spikes. Volatility between 20 and 30 is desired. Too much under 20 and there is little premium. Over 30 and you can lose on whiplash. The option bid-ask spread should be less than a 20% difference, so roll does not go to shrinkage. strike price strike prices spread should be $5 or less. A clear trend must be present. No earnings or significant news events between now and the expiration of the long leg. I happen to like European style cash settled ETFs. However, I may trade the SPY as well. Cash settled options reduce the risk of assignment. I did not get nervous by going to an in the money position. Cash settled European style options are S&P 500 index SPX, NASDAQ 100 index NDX, Russell 2000 index RUT, Volatility Index VIX, Dow Jones Index DJX, S&P 100 Index OEX, and S&P 500 Mini Index XSP. The rolling put diagonal is a swing trade for boring or slightly bullish stocks and indexes. If the criteria above are met and the momentum is bullish or flat, you will want to start a rolling put diagonal. It is a great strategy for mildly bullish to even slightly bearish, but it is not for heavy accumulation or a strong continued sell-off. Opening the trade. The rolling put diagonal is a hybrid between a put credit spread and a calendar spread. The short leg should be the next expiration or the one after it, and either at the money of Delta 50 or slightly in the money, depending on your trading style. Long leg should be out at least 14 to 90 days to expiration. Some traders go out as far as a leap and between Delta 30 and 40. A rough rule of thumb when opening a spread is that the income from the short leg should pay for roughly half of the cost of the long leg. This helps you pay quickly for the cost of the long and only deal with the margin hold from the spread. Ideally, the delta of the long leg will have a 20% to 40% difference from the short leg delta. Be careful going over a 50% difference in deltas because you want that long leg as protection in case of an overnight change of momentum. A lot of time the question will come up as to when to start a trade. It is just after a reversal in at least 2 days where the price closes above the MA9 line on a daily chart. In other words, for a rolling put diagonal, the price has pulled back and found support, and for 2 days there has been green candles with the price above the MA9 line. Rolling. At each expiration of the short position, you will roll the option strike up, down, or sideways to the next expiration. This is pretty much based on delta management and price movement. A narrow spread of the strike prices increases protection, and a wider spread produces more profit. You want the long delta to be at least 20% less than the short, but not more than 50% less. The difference, the less difference between the deltas, the more protection in a market reversal. However, having too high of a long delta can produce more dollars being lost in the long leg than the short. By the same token, the further away the long leg is from the short, the more profitable the time decay the movement can be. It is a balancing act between the difference in the delta, theta, and the market conditions. If the market goes down, it is perfectly fine to roll to the same strike next expiration if you think the market will come back. If not, then you can roll down both legs, the long vertically and the short out and down by the same strikes, preferably for a credit. No matter how small the credit, the market is paying you to sit and wait. On a short-term pullback, I tend to roll the same strike, next expiration, and capture the intrinsic value plus additional time value, which I will get back on a market recovery. Some traders roll to the next expiration at the money. It is your choice. An important element to rolling, besides what to roll to, is when to roll. Rolling is more of an art than a science. There are some points for guidance, but at the end of the day, it is a personal decision. Rolling is a balance of delta, theta, extrinsic value, market movement, and the time you have available. The game changer is understanding how these work to benefit your return and knowing when to pull the trigger because it is not necessarily based on the time of day. It includes how much extrinsic value is remaining, what the delta comparison is between the short income position and the higher value long protective position, the theta value of the current short position compared to the theta value of what you intend to roll to, and finally, what your schedule is. Rolling guidelines to consider include if the delta of the short is less than the delta of the long and is not expiration day, it is time to roll. A long protective put with a higher delta value than the short income producing position will work against you, and you will lose more value on the long protection than the short income position. Extrinsic value is not only a key value of how much you can earn based on time decay, but your probability of having the position assigned to you if your position is not expiring today. When extrinsic value is relatively low, it is time to roll. If this is expiration date and the extrinsic values are relatively high, it is still time to wait. Data is overlooked by a number of traders because it should be watched if you want to consider when to roll on an expiration day. You want to roll preferably when the theta on the current position is lower than the theta on the position you are rolling to. Rolling does not necessarily have to be the next expiration. In a pullback, you might want to give it some time to recover. Also, there may be some events where IV is higher because of some planned event, and you can get as much premium, if not possibly more, by rolling 2 days instead of one. Last but not least, this beauty of the strategy is that you can use it to fit your schedule. If you only have time to roll in the morning or at lunchtime, then that is a good time to roll. The odds of success are stacked so much in your favor with rolling diagonal puts that timing and direction do not limit the success of the trade. Another element to rolling is to manage the buying power used during the life cycle of the trade. When you start the trade, if it is XSP, you may have a buying power requirement of $550 or $750. As you roll the short income producing leg up, you are widening the spread and increasing your buying power required. Here's where there are different strokes for different folks. Some traders with larger accounts are fine with that and do not even measure the amount of buying power used. Others, like myself, are constantly watching the buying power used as an important performance metric. If you are also one to watch performance as a measurement of income to buying power used, you will want to set a limit on when you roll up your long leg. My threshold is when the buying power required hits $1,200 or greater, or when the long leg is less than a 20 delta. At that point, you should roll up the protective long. There are two methods I have used on adjusting the long protective put. One is to roll the long up to a 30 or 35 delta and at the same expiration period. If you enter this as a four-legged entry, rolling both the protective long legs and income producing short legs, you want to do it for a credit. The other way is to roll the long leg to a closer expiration, an up in strike, and selecting strikes that an expiration so the cost is minimal. It's not uncommon to be able to roll to a day or two less expiration date and up in strike to conserve buying power used for less than a dime cost. You can also enter this roll as a four-legged entry. Be aware how the brokers fill rolling or spread orders. They send the order to the same clearinghouse, so just because the quotes say the net credit might be so much, that could be using best price from multiple clearinghouses as opposed to what does it cost from the same one. In the beginning, do not get fancy. Just leave rolling to be mechanical by putting in a two-legged order, one to buy to close the current short position, and the other to sell to open the new short position out further in time. Roll to the next expiration. As you get the experience, you can make rolling more of an art if you think you can capture additional premium by legging into the roll. Reversals. What goes up must come down, but what goes down may not come back up. When there is a reversal, you have three choices. One, close both legs and wait for the market to clearly show a return to a bullish trend. Two, take off the short position Let the long position continue gaining value. 3, continue rolling the short and either roll the short out to the next expiration and same strike if there is a chance of the price recovering before the long leg expires, rolling both the long and short legs down. If you roll both legs, roll the long leg down within the same expiration period, capturing an increase in value, and roll the short leg down, same number of strikes, but to longer days to expiration. 4, possibly consider adding to the position since you will get a larger credit on a pullback if it's temporary. When to do when What to do when price drops. I've spent a lot of time challenging my exit rules. Personally, challenging a trading plan is a good thing that can either confirm or modify rules, hopefully for the better. The deeper I dig, the more I am believing that my rules of when to get in and when to get out are solid for me, my style, and my account. The chart I am using are multiple time frames with a 98-minute chart, 78-minute, 135-minute, and daily, and with primarily two indicators with candlesticks, the EMA 9 and MACD. It does not matter between an SMA or EMA. They are so close it gives the same results. The 98-78 may sound different, but mathematically they give relatively full slices of data on a 33 90-minute trading day. Now for the mechanics. If I am in an RPD and the price pullback but stays above the MA9, I roll the short legs to the same strike and enough time further out in expiration to get a credit on the roll. I do not believe in doing rolls for a debit. I have seen too often debits in my mind is the beginning of a slow death. Going back to the pullback on a 98-minute chart, if the price closes below the MA9, watch the 78-minute chart to make sure the pullback is a continued momentum. If it is by the completion of the second candle on the 78-minute chart and the candles are red, either close the RPD or buy back the short leg and let the long leg increase in value if the pullback continues. If it reverses and goes back above the MA9, you can easily sell the short put again at the same strike, different expiration. In getting into an RPD, the price must be above the MA9 and the MACD lines are bullish. Please remember, this is my trading plan that I am sharing. I am not giving anyone advice on how to trade. Management. An important element of the rolling put diagonal is delta management. When opening the trade, you want the difference between your long and short positions to have at least a 20% difference. For example, if your short leg is 50 delta and the long leg should be 30 to 40 delta. Delta management is a balance of how much net premium to collect on the short versus the amount of protection of the long. A delta of 25 or less on a long protected put provides little protection in a market reversal because it typically incurs a significant loss on the short before affecting the increase of the long option. By the same token, if the delta on the long becomes higher than the short, you stand a high chance of losing more dollars on the long than you are gaining on the short on a strong bullish run. When adjusting the long delta, that would be a vertical roll within the same expiration and making it closer to the price. You do not need to roll out the long on protective delta adjustment. The diagonal is one of the most flexible strategies I've ever done. When the market's relatively flat, you just roll the short and collect time premium. If there is an overall change in momentum, close and wait it out or buy back the short for probably a loss, but then let the long leg increase in value if the pullback continues. Remember that a one-day switch is not a change in momentum. Some people follow a 2 or 3 day rule to verify a momentum change. Tips from experience. This is not a day trade, so do not panic if one day there is a price spike or a gap down. It might come back the next day. Give it 1 to 3 days to verify a new price range. Rolling out of a pullback is much preferred to closing the trade. Put it simply, rolling can keep the trade alive, even if it means rolling both legs if an adjustment is needed. This strategy utilizes the general trend of the underlying. If you are doing a horizontal roll and it is in the money, when there is a short-term pullback, you can experience a reduction in your net lick. But if you do it for a credit, it will increase your cash balance. On a recovery, the net leg returns because the intrinsic value on the short. The key is to continue to roll for a credit and keep the intrinsic value if you think the market will come back to the bullish trend before the long leg expiration. Make sure there are weekly or daily options. Do not do this on monthly expirations. Ideally, do European cash settled options so there are no potential assignments of in the money positions. Do not overpay for the protection by buying a long protective put too far out in time. If you are in a position that has weekly options, place the long leg 60 to 90 days out. If the position has daily expirations, position place the protective put 14 to 30 days out. If you are choosing a stock, buy the long past the next earnings date and close the diagonal 2 weeks before the earnings date to avoid potential volatility. Watch the deltas. However, keep in mind theta decay. Make sure the short delta is higher than the long delta. Otherwise, you can lose money on the reduction of the long versus the gain on the short. When to roll is based on the extrinsic value of the short and the market direction. Ideally, you will roll when the market price is at the short strike price and time value is low. You can roll before expiration if the time value is less than 10 cents as well. Some people claim to have an advantage when legging in and out. However, I have found it to have 50-50 results. My preference is to enter with two legs and exit with two legs. Getting fancy in my case does not give me an edge over boring execution. Wait for at least an hour after the market opens to roll the short and to do it before the last hour. Both of those time frames can have wide bid-ask spreads. In a short-term reversal, 1 to 2 days, it might be an opportune time to add to the current RPD at a small price and usually covering the cost of the long protective position with the premium from the short income leg. Just make sure that this is not a trend reversal, but a short-term pullback. Last and not least, stay with the KISS principle. Getting fancy with additional transactions has never worked long-term for me. In conclusion, I have had the good fortune over my trading journey of 25 plus years to cover a myriad of market conditions that has including trading almost every strategy possible. Remember what the market gives, the market can take away. I stay on the put side of the rolling put diagonal because puts generally have better premiums and overall, and except for a couple of years, the market has been bullish. I do not do a call diagonal because the price can bounce back strong. And in a diagonal spread, you do not want that strength going against you. If the symbol turns bearish and you want to stay in it, I have found taking off the short leg and leaving the long leg on gave the best results. I have been involved with several groups and individual traders that are successful. I am thankful that they have helped increase my horizons and gain more knowledge than I would have with the PhD. But it has also come at an expense equal to, if not more than getting a PhD. As previously mentioned, the rolling put diagonal was a strategy that is based on the money press from Trader's Edge that was started when weekly options were introduced. I thank Trader's Edge and Preston James for the strategy, and I have made enhancements that gives me what I believe is better performance. The principle is still the same. Sell a short-term option near or at the money and buy a long-term option for margin management and portfolio protection. I applaud scalpers, day traders, and zero DTE traders, but I have to admit I am not one of them. I'm also not one to sit by a computer screen watching multiple screens for the adrenaline pump. I have a supportive family and other responsibilities, and in general, a life. I do not like the excitement of hoping there is not a jump in price at the close and take out my position. I prefer to spend my time on boring trades that can take advantage of the single element I believe I can count on, the passage of time. My purpose in putting this together and documenting what I have found works for me is to pay forward to any trader that is challenged and has the same priorities I do of taking care of family and being relaxed in trading. I cannot give advice or tell people what to do, but I can share what has worked for me. And that is exactly what I am doing, sharing this trading plan. Good luck and good fortune. Author Bill Belt. And thank you, Bill Belt, for the trading plan document.